Welcome to the CFA Level 1 Practice Test 1. Domain, Fixed Income, Part 5. Which provision is best described as a negative covenant? A. The issuer is obligated to maintain its existing lines of business. B. The issuer is prohibited from selling certain key assets without bondholder approval. C. The issuer is required to file financial statements with the trustee in a timely manner. D. None of the above. Answer is B. The issuer is prohibited from selling certain key assets without bondholder approval. Adoption of new lease accounting is most likely to lead to a decrease in bond yields due to enhanced financial statement comparability. B. An increase in bond yields due to higher reported financial leverage. C. No change in bond yields if underlying cash flows are unaffected. D. Not applicable. Answer is B. An increase in bond yields due to higher reported financial leverage. Which statement best describes Macaulay duration? A. It quantifies bond price change for a unit change in yield, assuming parallel shifts. B. It is a measure of the weighted average time until a bond's cash flows are received. C. It measures sensitivity of bond price to changes in the shape of the yield curve. D. All of the above. Answer is B. It is a measure of the weighted average time until a bond's cash flows are received. Which describes the financial statement and asset sale provisions in a corporate bond indenture? A. Both provisions are negative covenants. B. A financial statement provision is affirmative, asset sale restriction is negative covenant. C. Financial statement provision is negative, asset sale restriction is affirmative covenant. D. None of the above. Answer is B. A financial statement provision is affirmative, asset sale restriction is negative covenant. What is the approximate modified duration given the bond price changes for a 20 bps yield change? A. 6.12. B. 6.35. C. 5.88. D. Not applicable. Answer is C. 5.88. Which CMBS call protection involves purchasing government securities to cover mortgage payments? A. Defeasance. B. Yield maintenance. C. Prepayment lockout. D. None of the above. Answer is A. Defeasance. To compare yields with different day count conventions, the manager should first A. Directly subtract treasury yield from corporate yield, day count is immaterial. B. Multiply corporate yield by 360/365 to convert to actual/actual basis. C. Multiply corporate yield by 365/360 to convert to actual/actual basis. D. Not applicable. Answer is C. Multiply corporate yield by 365/360 to convert to actual/actual basis. Which bond will experience a greater percentage price decrease if market rates rise by 75 basis points? A. Higher coupon bond will have a greater decrease. B. Both will have similar percentage decreases. C. A lower coupon bond will have a greater decrease. D. None of the above. Answer is C. A lower coupon bond will have a greater decrease. What is the price closest to a bond with 5% annual coupon, 3 years maturity, and 6% market rate compounded semi-annually? A. $950. B. $972.91. C. $1,000. D. Not applicable. Answer is B. $972.91. An investor pursuing higher yields is most likely accepting increased A. Credit risk. B. Reinvestment risk. C. Purchasing power risk. D. None of the above. Answer is A. Credit risk. Thank you for watching. For more learning videos and tutorials, subscribe to BISP Trainings.